As an investment advisor, the most commonly asked question is, when should I sell my investments? And when I am asked that question by my investors, I follow it up with two more questions to them. One, why do you want to sell your investments? And when they try to answer that question, it leads them to another question being, why did I first actually buy those investments? If you want answers to these questions, watch this video till the end while I help you decide when you should sell your investments. Hi, my name is Harshvardhan Dawar, founder of Wealth Cafe, where we help you make smart money decisions. Let me play out two scenarios for you. First one, you decide that you found a share which is very interesting and it's going to give you a lot of returns. You go and buy the share today in the market when the market's open for an amount of INR 600 rupees per share. You buy the share and decide to sit tight that this is a share which is going to make you a lot of money. A couple of days pass, a couple of weeks pass, and then you see that the value of the share starts falling. And you begin to get worried that why is the value of the share falling? It falls from 600 to 550 to 525 and to 500, and that's when you start to panic and you say that you bought the wrong share. You decide to place a sell order and exit the share. The day you sell the share, it's at 500 rupees, you booked a loss of 100 rupees per share, and then what happens? You find that the next day after you sold the share, the value of the share actually starts going up. It goes up from 500 to 525, eventually to 550. It crosses your buying price of 600 and then goes up to 700, 800. And during all this time, you're sitting on the sidelines and wondering, why did it have to fall after the day you bought the share? Does this scenario give you a kind of deja vu? Well, if it does, let me play out a second scenario for you. You get advice from somebody, or rather a tip from a friend saying that a certain share is going to do really well and you decide to buy the share. This time, you do your research also and find that yes, this share looks good, and you go and buy the share. You buy it for an amount of INR 1200 rupees and you decide to sit tight after that. What happens for a few months after that is the share does not do much. It stays at 1200 rupees. Maybe 6, 8, 12 months down the line, you're wondering why nothing is happening to the share, and then it starts to move up. It moves up to 1250, it moves up to 1300, it moves up to 1350, and in about 15 months when it is at 1400 or 1450, you feel very happy about the decision you've made and you say that yes, I've made a good profit in the share, and you decide to book your profits. So you bought it for 1200, you sell the shares for about 1450 rupees a share, and you are extremely happy about the fact that in a period of 15 months, you've made a profit of 250 rupees per share that you invested in. But then what happens after you sold the share? You somehow find that after you sold the share price starts going up higher and higher. It goes up to 1500, 1600, and before your eyes, you're sitting and wondering why did you exit the share once the share hits a price of 2000 rupees. You're lamenting the fact that you sold the share too early and you could not take advantage of the rally in the share because you decided to exit and book your profits in that particular share. This scenario also, I think, would be giving you a deja vu of the fact that it would have happened to you at some point in time in your investing career, especially if it was sometime early in your career. Now, both these scenarios are pretty common, and the reason they occur is because when the investor decides to buy a particular share, he does not know the reason why he is buying the share, or he does not know the purpose for which he is buying the share. He does not know the tenure for which he is buying the share. He buys the share because somebody has told him it's a good share. He buys the share because there is a market tip that the company is going to do well, or he buys the share only because everybody in the office around him are talking about the fact that the share is a fantastic buy. Now, because you do not know the reason of why you bought the share, after you buy the share, you sell again on whims and fancies of when you think it is a good time to sell, or when you think that you should book your profits, or when you think that, okay, I've made a loss, I should get out of it. Because you've not done your research into why you bought the share, you're going to be equally confused when you arrive at, or when you have to take the decision of when should I sell a particular investment. There are two scenarios which make it very easy for you to decide as to when you must sell a particular investment that you hold. The first one is when you need the money for a goal that you set out investing the money for. For example, if you're 25 years old and you have a kid who is 1 year old and you decide that I want to send my kid abroad and I need a crore of rupees when he or she is 21 years old to pay for her post-graduation, then you know that when you are at the age of 45, when she will be at the age of 21, that is when you need the money. So maybe 2 to 3 years before you actually reach the age of 21 for her or 45 for you, you would start withdrawing the money out from high risk assets like equity and real estate and start moving them into low risk assets like debt, so that when you reach the age of 45 or your child is ready to take the plunge into post graduation, you have the money safely put aside in a kitty that can be withdrawn and used for the purpose for which you decided to start your investment in the first place. So that at the age of 21, you have the money ready with you and you do not have the shock of a market crashing right at the age of 21 and the 1 crore rupees actually landing up being an amount of 60 lakhs or 70 lakhs, resulting in a shortfall. So the first reason why you would want to sell an investment is when you're nearing the goal, when you're nearing the purpose for which you decided to start saving the money in the first place, that becomes the first trigger for you to understand that I should go ahead and sell my investments. The second reason why you would look at selling a particular investment is if the allocation of the various asset classes in your portfolio are out of sync. Now, what do I mean by this? This means that when you invested the money in a particular security, you were clear that this is a part of the equity portion of my portfolio or this is a part of the debt portion of my portfolio, and I as an investor, I have a certain risk profile. So for example, if you are an aggressive investor and you have a risk profile where 70% of your investment is into equities and 30% is into debt, then when you are actually making an investment, you know exactly why you're doing it. It is a part of either the equity portion or the debt portion, and you know that at any point in time, you must have an allocation of 70 and 30. So when you have this set asset allocation for yourself, you have a reason for why you bought a particular stock. You know that if this asset allocation goes out of sync, so for example, if markets were to crash and your ratio of 70-30, it falls down to maybe 50-30 because markets crashed by at about 40%, right? Which we saw in the month of March 2020. If you see such a scenario play out, then you know that you need to sell a part of your debt investments and buy some more equity so that your allocation is back to your target allocation of 70-30. Similarly, if today you're sitting on a lot of profits where the markets have more than doubled and you're wondering whether you should sell your investments, the answer to that again is going to be for you to go back and look at your asset allocation and see that if the 70-30 allocation today, because of the profits you've made in the equity market, has gone up to say 85-15, that 85% of your portfolio is in equity and only 15 is in debt, then you need to sell a part of your equity. How much? 15% of your equity, so that you bring it back in sync to 70-30. If you look at both these scenarios, you will understand that deciding on when you should sell is extremely easy if you are very clear on why you are selling the investments, and second, and more importantly, why did you buy that investment in the first place? If these two answers are available with you, then taking the decision of when to sell becomes extremely easy. The key learning for you from this is that arriving at the decision of when you must sell is a decision which is based on your individual personal finances. That is, when you need the money for your goals or when a certain investment is out of sync with respect to your individual risk profile. You will not take the decision of selling based on what your neighbor is telling you or what the guy on the TV news channel is suggesting. You will take the decision based on what is required for you as an investor. It is as simple as the fact that when you have an ailment, you will take a certain medicine which the doctor prescribes for you based on your history, based on the allergies you have, based on your requirement for a certain symptoms that you showed, right? You will not take a medicine based on what was prescribed to your neighbor, right? That's exactly what goes for investments as well, that you never make an investing decision based on what somebody else is doing, but make the decision based on what is good for you and what is going to help you achieve your goals in the long run. If you have a friend who's facing a similar dilemma of when should he sell his investments, do share this video with him and like, share and subscribe our channel for freshly brewed content every Wednesday and Saturday.